Hi everyone, I am Dr.A.NAGALAXMI, Assistant Professor, Department of Commerce with Finance in Dr. S.N.S. Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. I am here to explain a concept called as depreciation and depreciation accounting. Depreciation deals with AS6, accounting standard AS6. So this standard deals with depreciation accounting and applies to all depreciable assets except the following items to which special considerations apply. That is forest, plantation and similar regenerative natural resources, wasting assets including expenditure on the exploration for and extraction of minerals, oils, natural gases and similar non-regenerative resources, expenditure on research and development, goodwill and other intangible assets. We should know what is meant by depreciation. Depreciation, it is an accounting method that determines a fixed asset's value is reduced over its usual life. This is called as depreciation. The most common depreciation method is straight line depreciation, which is often used for equipment that loses value steadily over time. Depreciation is an important thing that should be it represents the estimated reduction in the value of a fixed assets within a fiscal year. Tangible assets such as buildings, equipments, vehicles and so on are purchased in large lump sum value. The value of these assets decreases over time after they are purchased because of wear and tear, obsolescence. Depreciation represents the estimate for how much time this value is declined in a given fiscal period. Accounting standard do not allow up to the expense the entire value of the asset in the year they are purchased, because their value is derived over a long period of time called the expected useful life. Once this cost is recognized on income statement, the value of the asset value on the asset balance sheet is also reduced. This continues until the cost of the asset is fully expensed or the asset is sold or replaced. Depreciation is an accounting method for estimating that decline over time. It helps businesses match their revenues with cost, including those of asset used to generate revenues. Businesses need to take this decreasing value into consideration when analyzing their performance and determining the cost of producing their products and delivering services. This allows them to then build reserves to replace these assets once they can no longer be of productive use. When a depreciation expense is charged to the income statement, the value of the long-term asset recorded on the balance sheet is reduced by the same amount. This continues until the cost of the asset is fully expensed or the asset is sold or replaced. How to calculate depreciation? Several methods can be used to calculate depreciation. Business owners are usually familiar with depreciation method used for tax purposes. These require businesses to spread out the reporting of cost of longer term asset over the useful life of the asset. But depreciation for the tax purpose does not necessarily represent a company's actual cost for the use of fixed asset. It is common and acceptable for the business to use a parallel depreciation method for financial reporting purpose that more accurately reflects the asset's decreasing value. The most common depreciation method are straight line method and declining balance. It is also called as diminishing balance method or written down value method. In straight line depreciation method, the asset is depreciated by the same amount for each year of its useful life. The next method, that is declining balance method or written down value method or diminishing balance method. With the declining balance method, the asset is depreciated by the same rate for each year of its useful life. This method is sometimes used to reflect the fact that asset lose more value early in their life. So these are the two methods of depreciation.